Between them, these two funds hold over 250 billion euros of European investors' money, a quarter of a trillion. They are two of the most popular ETFs on the continent. And in my last video, I said that when you start out, you likely choose between a fund tracking the US market and one tracking the broad global market. So today, as promised, the two funds that actually do that side by side with real numbers. The S&P 500 versus the MSCI World. And by the end, a word of caution, because popular and right for you are not the same thing. Quick word on who's telling you this. 23 years in finance, 16 as an executive director and board member at a development bank, on the credit board, approving thousands of financing decisions. I am not selling anything, and for full transparency, I own one of these two funds myself. But this is not advice. It's information, so you can decide. First, a proper definition, because everything rests on this. ETF stands for Exchange Traded Fund. Let us break it in two. A fund is a big pot of money from thousands of investors pulled together to buy a basket of assets. Here, company shares. Put money in, and you own a slice of the whole basket. Exchange traded means it trades on the stock market like an ordinary share. Buy or sell any moment the market's open, at a live price, unlike old-style funds that price once a day. So, in a single move, for the price of one share, you own a tiny piece of hundreds of companies at once. That's instant diversification at very low cost, because nobody's paid to handpick stocks. The fund just quietly copies a list, and that list is called an index. I'll get to the two specific indices these funds are based on in a moment. But first, let us understand how a fund actually copies an index. There are two main ways, and our two funds use one each. The first is full replication. The fund buys every company in the index in the exact same proportions. The S&P 500 fund does that, all 503 positions. The second is sampling. Rather than holding every single name, the fund tracks the index with a representative set that behaves almost identically. The MSCI World Fund is run this way, holding around 1,300 companies. Either way, the goal is to match the index as closely as possible. It will never be perfect. There is always a tiny gap, mostly the fee you pay. That's why a low fee matters. You are not betting on a star manager, you are buying the market's average as cheaply as possible. Now the indices, because this is where the funds generally differ. The S&P 500 is the 500 largest US companies, chosen by a committee against very strict rules. The key detail, it's weighted by size. The bigger the company, the bigger its slice. So it's not 500 equal bets. The giants dominate. Today, the top 10, Nvidia, Apple, Microsoft, and friends, they are nearly 38% of the whole index, the most concentrated it has ever been. It captures roughly 80% of the entire US market. In short, a size-weighted bet on corporate America, tilted hard towards big tech. The MSCI World holds around 1,300 large and mid-sized companies across 23 developed countries. The US, Japan, the UK, Canada, Western Europe, Australia. First, it's also weighted by size. And because America is by far the biggest market, the US alone is about 67% of this world index. Second, and most people miss this, world means developed markets all. It deliberately excludes every emerging market. China, India, Brazil, all of it. So it's broader than the S&P, but it's not the whole planet. One thing both funds share, they are both iShares funds, the ETF arm of BlackRock, the largest asset manager on earth, managing trillions. So we are not comparing two obscure products. We are comparing two flagships from the same house. Now, the funds. And a practical tip first. Each one trades on several European exchanges, and the ticker changes by exchange. The S&P 500 fund is SXR8 on the German exchange, CSPX on Amsterdam, CSSPX in Italy and Switzerland. All the identical fund. The one thing that never changes is the ISIN, IE00B5BMR087. So, when you search for it, use the ISIN, not the ticker. Same with the MSCI World Fund, EUNL in Germany, IWDA on Amsterdam, SWDA in London and Switzerland. ISIN is IE00B4L5Y983. Now costs. The S&P fund charges 0.07 a year, the MSCI World 0.2% per year. Both Irish domiciled, both reinvest dividends automatically, both enormous, around 129 and 122 billion respectively. That fee gap sounds tiny, so let's make it real. On 10,000 euros invested, 0.07 is 7 euros a year, 0.2% is 20 euros a year, 13 euros difference. Now, let it run over 20 years at a typical 7% return. The cheaper fund leaves you with roughly 900 more euros on that 10,000 euros invested, because the fee, like the returns, compounds. So yes, a lower fee is real money, and it's why we always check it. But keep it in proportion. 900 euros over 2 decades is small next to the real decision here. One country versus the whole developed world. Don't let a 13 basis point fee gap between 0.2% and 0.07% be the thing that decides it. The strategy matters far more than rounding on the fee. Now, the numbers. As of June 2026, in euros, dividends included. Over 1 year, the S&P 500 was up about 25%. The MSCI World up about 24%, almost identical. Over 5 years, the S&P 500 was up about 99%, nearly doubling your money, versus about 82% for the MSCI World. There is the gap. Over 5 years, the S&P pulled meaningfully ahead. And since each launched, the S&P is up over 800%, the MSCI World over 630%. But careful, they launched almost a year apart, 2010 and 2009. So those headline numbers aren't a fair head-to-head. That's exactly why we trust the 1 and 5 year figures, where both are measured over the same window. So the S&P 1, case closed, not so fast. 1. These two are far more alike than they look. Remember, global, MSCI World is still 67% US, and its top holdings are the same American giants as the S&P, just at smaller rates. The World Fund is mostly America with a 33% international tail. 2. The S&P won on return, but not on risk. MSCI World was less volatile every period, fell less in the bad stretches, and gave a better return for each unit of risk. Higher return isn't the same as better investing. 3. Remember this one. The S&P does not always win. In 2025, the MSCI World beat it, up 7.1% versus 4%. The most recent full year already flipped. So, the honest takeaway, and I won't hand you a winner, because there isn't one. The S&P has delivered more over the past 5 years, and over most of the both funds' lifetime. The MSCI World gave you a broader, smoother ride, which fits you, depends on your risk tolerance and how much faith you put in one country versus the whole world. And honestly, it depends on more than just those two things. Your time horizon is a big one. Someone with 30 years until retirement can ride out decades of ups and downs that someone needing the money in 5 years simply can't. So does what you are investing for, a comfortable retirement, a head start for your kids, a specific purchase down the road. Each one tilts the balance between chasing growth and wanting a smoother ride. Those are exactly the questions I'll dig into in upcoming videos. For today, the point is simple. The best fund for you is the one that fits your timeline and your goal, not the one with the highest recent return. But here is what I really want you to hear. Agonizing over which of these two to pick matters far less than one thing: actually starting. The most expensive mistake I ever made wasn't choosing the wrong fund. It was waiting. Years ago, a professor of mine told me to start investing. I didn't listen, and I lost the better part of a decade of compounding before I did. In my next video, I'll tell you that whole story with the real numbers on exactly what that delay cost me. Because the best fund you never buy returns nothing. As always, I'm not a financial advisor. This isn't financial advice. It's education. I mentioned that I own one of these funds purely for transparency, not a recommendation. And always remember, do your own research. Next, on the banker's notes, the investing mistakes that quietly cost people the most, starting with the recency trap we just touched. If this helped, a quick like helps more people find it. Subscribe so you can catch the next one and the full series in the playlist.